Look at your last paycheck, not the number at the top, the number at the bottom. The gap between what you earned and what you actually received. That missing chunk, the one the government took before the money ever touched your hands, feels as permanent as gravity. Like it's always been there. Like it's always been this way. It hasn't. For the overwhelming majority of human history, no government on earth taxed its people's income. Not a single one. The idea that a state could reach into your earnings and take a percentage, automatically, silently, before you ever see it, is barely 2 centuries old, and the man who invented it promised it would be temporary. By the end of this, you'll understand exactly how governments funded entire civilizations without ever touching a worker's wages, why that changed, and how a wartime trick from 1943 made you stop noticing the money disappearing from your paycheck altogether. A world of taxes. But not this taxes are old. Taxes are ancient. The first recorded tax system dates back roughly 5,000 years to ancient Mesopotamia, where clay tablets from the city of Lagash describe citizens paying taxes in the form of livestock, grain, and labor. The pharaohs of Egypt taxed harvests. The emperors of China taxed salt. The kings of medieval Europe taxed land, trade, and the goods that moved through their ports. Governments have always found ways to fund themselves, but for thousands of years, none of them did it by taxing what people earned. The concept simply didn't exist. Think about what that means. An Egyptian farmer in 2000 BC paid taxes on his wheat harvest, a portion of what the land produced, not what he himself earned for his labor. A Roman merchant in the 1st century paid customs duties when his goods crossed provincial borders, but nobody asked him how much money he made in a year and then demanded a percentage. A medieval English peasant owed labor to his lord and tithes to the church, but these obligations were tied to his status, his land, and his relationship to the feudal hierarchy, not to his personal income. The distinction matters enormously. Taxing goods, taxing land, taxing trade, these are all ways of skimming value from things that move through the economy. They tax what happens outside of you, your harvest, your cargo, your property. Income tax is different in kind. It taxes what happens inside your economic life, the total value of your labor, your effort, your skill. It requires the government to know what you earn. It requires you to disclose your private financial life to the state. It requires a bureaucracy capable of tracking, verifying, and collecting money from every individual in the country. And consider what that bureaucracy looks like in practice. Today, the United States tax code runs to over 10 million words. The IRS employs roughly 80,000 people. Americans spend an estimated 6.5 billion hours per year preparing their tax returns. An entire industry, tax attorneys, accountants, software companies, financial advisors, exists solely because the system is too complex for most people to navigate alone. The infrastructure required to collect a tax that didn't exist 230 years ago is now one of the largest administrative operations in human history. For most of history, no government had either the desire or the ability to build anything like it. How empires actually paid their bills. If income tax didn't exist, how did the greatest civilizations in history fund themselves? The answer is a patchwork of methods, some clever, some brutal, and some so strange they seem almost fictional. Ancient Rome ran on a system of indirect taxes and something called tax farming. The Roman state didn't collect most taxes directly. Instead, it auctioned off the right to collect taxes to private contractors called publicani. These men paid the government a lump sum up front, and then went out and collected whatever they could from the population, keeping anything above what they'd paid as profit. The incentive structure was exactly as corrupt as it sounds. Publicani had every reason to squeeze citizens for as much as possible. They used intimidation, fraud, and outright extortion. The tax collector became one of the most despised figures in Roman society, so hated that the New Testament repeatedly groups them with sinners. When Jesus sat down to eat with tax collectors, the scandal wasn't that he was dining with bureaucrats. It was that he was dining with men who were widely viewed as thieves operating under the protection of the state. Rome also levied the tributum, a direct tax on property, and, in conquered provinces, a head tax on individuals. Citizens of Rome itself were eventually exempted from the tributum, one of the perks of citizenship, but provincials paid heavily. The system funded legions, roads, aqueducts, and the administrative machinery of the largest empire the Western world had ever seen, all without ever asking a single person how much money they made. In medieval Europe, the model was different, but the principle was the same. Kings funded their courts and their wars through a combination of feudal dues, customs duties, and extraordinary levies. Feudal dues were obligations tied to land. If you held land from a lord, you owed him service, military service, labor, or a portion of your crop. The lord, in turn, owed the king. This cascading structure of obligation funded the medieval state without any centralized tax collection at all. When kings needed more money, and they always needed more money, usually for war, they imposed special levies. In England, these took forms like tallage, scutage, and the notorious practice of forced loans, where the crown simply demanded money from wealthy subjects with the vague promise of paying it back. Sometimes they did. More often, they didn't. The church ran a parallel system. The tithe, 1/10 of your produce, was owed to the church regardless of what you owed your lord. For a peasant farmer, the combined weight of feudal dues and church tithes could consume 40 to 50% of everything they produced. They were taxed heavily. They were taxed constantly. But they were never taxed on income, because the concept hadn't been invented and because medieval economies ran on barter, labor, and kind. Not on salaries and wages that could be neatly measured in currency. The system had a certain blunt honesty to it. You could see what was being taken. A tax collector arrived and physically removed a portion of your grain. Soldiers showed up and demanded you serve or pay scutage to avoid serving. The king imposed a levy and men came to your door. Taxation was visible, tangible, and often violent. What it wasn't, ever, was automatic or invisible. And then there were the creative taxes, the ones that revealed just how far governments would go to raise revenue without touching income. In 1696, England introduced the window tax. Rather than assess people's wealth directly, which would have required inspecting their finances, the government simply counted the number of windows in their homes. More windows meant a bigger house, which meant a wealthier owner, which meant a higher tax bill. The logic was crude, but effective. The response from citizens was equally creative. People bricked up their windows. Landlords sealed entire floors of glazing to reduce their tax liability. The poor, who could barely afford to pay, lived in increasingly dark and airless rooms. Walk through old neighborhoods in London, Edinburgh, or Dublin today, and you can still see buildings with sealed windows, blank rectangles of brick where glass once let in the light. The architectural scars of a tax that lasted for over 150 years, visible on the street more than a century after the tax was finally repealed in 1851. The phrase daylight robbery is widely believed to have originated from this period, though historians debate whether that's strictly accurate. Regardless, the spirit is right. The government found a way to tax sunlight. Before the window tax came the hearth tax of 1662, a levy based on the number of fireplaces in your home. Tax inspectors had the legal right to enter your house to count them, which made the hearth tax one of the most bitterly resented taxes in English history, not just because of the cost, but because of the intrusion. It was repealed in 1689, partly because of its unpopularity, and partly because inspectors were sometimes attacked. Before hearths, There were taxes on doors, on chimneys, on the number of servants. Governments would tax almost anything they could observe, count, or measure from outside your life, rather than demand to see what was happening inside your finances. France had the gabelle, a salt tax so hated that it helped trigger the French Revolution. Spain imposed the alcabala, a sales tax on every commercial transaction. The Ottoman Empire taxed non-Muslim subjects with the jizya, a per-head levy that simultaneously raised revenue and reinforced the social hierarchy. Each system was different, but the underlying logic was identical. Tax things, tax transactions, tax status. Never tax the money a person earns through labor. That boundary, the idea that a person's earnings were private, that the state had no right to know what you made, was considered almost sacred. A government that could see your income could see everything about you. How much you worked, what deals you made, how wealthy you really were. For centuries, citizens and subjects across every culture resisted that level of transparency with the same instinct that makes people close the curtains at night. Your finances were your own. Breaking that boundary would require extraordinary circumstances. The Man Who Broke the Boundary by 1798, Britain was in trouble. Napoleon's armies had conquered most of continental Europe. The French Navy threatened British trade routes, and the cost of fighting the most ambitious military campaign since the fall of Rome was draining the British treasury at a catastrophic rate. William Pitt the Younger had been Prime Minister since he was 24 years old, the youngest in British history. He was a gifted administrator, meticulous with numbers, and he understood that Britain's existing tax system couldn't generate enough revenue to fight a war of this scale. Customs duties and tariffs were already stretched to their limits. The window tax and other property-based levies weren't bringing in enough. Voluntary contributions from wealthy citizens, which Pitt had tried, raised less than half of what was needed. On January 9, 1799, Pitt stood before Parliament and proposed something that had never been done before in any modern nation: a tax on income. Every person in Britain earning more than £60 per year would pay a graduated tax, starting at a fraction of a penny per pound and rising to a maximum of 10% on incomes above £200. Pitt was careful to present this as a temporary emergency measure, a war tax, nothing more. Once Napoleon was defeated, the tax would be abolished. He knew it was radical. He knew it was invasive. And he knew it crossed a line that British citizens considered fundamental: the right to keep their earnings private from the state. Parliament resisted, debated, and ultimately passed it, because the alternative was losing the war. The tax raised about £6 million in its first year. Significant, but less than Pitt had hoped, partly because widespread evasion and underreporting immediately became problems. When you ask people to voluntarily disclose their income, many of them lie. In 1802, when a brief peace with France arrived, the tax was promptly repealed. The British public celebrated. When war resumed a year later, the tax was reintroduced under Prime Minister Addington, this time with a crucial innovation: income was taxed at the source. Instead of trusting people to report honestly, the government collected the tax directly from employers and banks before the money reached the individual. This was the birth of withholding, and it changed everything. Not just about how much revenue the tax generated, which roughly doubled, but about the psychology of taxation itself. When you never see the money in the first place, you don't feel the loss as acutely. The tax becomes invisible. It stops feeling like something being taken from you and starts feeling like something that was never yours to begin with. After Napoleon's final defeat at Waterloo in 1815, the British public demanded the tax be abolished. In 1816, Parliament repealed it, and the Chancellor of the Exchequer ordered that all records related to income tax assessments be destroyed. Not archived, destroyed. The public's hatred of the tax was so intense that the government wanted to make sure it could never be easily reimposed. It was reimposed anyway. In 1842, Prime Minister Robert Peel brought back the income tax, again as a temporary measure, this time to cover a budget deficit. He stood before Parliament and made the same promise Pitt had made 4 decades earlier. This would be short-lived, a stopgap, a bridge to better times. Members of Parliament voted for it on that understanding. Some of them probably even believed it. That was 1842. It has never been repealed since. Every year since then, the British government has collected income tax from its citizens. Every year, politicians have discussed reforming it, adjusting it, making it fairer. What no major political party has ever seriously proposed is abolishing it. Nearly 2 centuries of temporary. The word lost its meaning the moment the revenue started flowing. America's reluctant embrace. Across the Atlantic, the United States wanted nothing to do with income tax. The entire structure of American government was designed to avoid it. The federal government funded itself almost entirely through tariffs, taxes on imported goods. For the first 70 years of the Republic, customs duties provided 80 to 90% of federal revenue. No income tax, no payroll tax, no sales tax at the federal level. If you were an American citizen in 1850, the federal government essentially never asked you for money directly. You paid higher prices for imported goods, and those prices quietly funded the government. Most people barely noticed. The Civil War shattered that arrangement. Just as Napoleon's wars had pushed Britain past its fiscal limits, the American Civil War pushed the United States past its own. In 1861, President Lincoln signed the Revenue Act, imposing the first federal income tax in American history, a flat 3% on incomes above $800. A year later, the rate was increased, a graduated structure was introduced, and the Bureau of Internal Revenue, the ancestor of the IRS, was created to administer it. Lincoln, like Pitt before him, promised it was temporary, a wartime necessity. And unlike the British experience, the American government actually followed through, mostly. The Civil War income tax was gradually reduced after the war ended and fully repealed in 1872. For the next 40 years, the United States returned to its tariff-funded model. There was no federal income tax, none. American citizens went about their lives, earned their wages, kept every cent, and the government funded itself on import duties. An entire generation of Americans grew up, worked, retired, and died without ever paying $1 in income tax to the federal government. If someone had told them that within a few decades, the government would be automatically deducting a quarter of every worker's paycheck before they saw it, they would have thought you were describing a dictatorship. In 1894, Congress tried. They passed an income tax as part of the Wilson-Gorman Tariff Act, a 2% tax on incomes above $4,000. It lasted exactly 1 year. In 1895, the Supreme Court struck it down in Pollock v. Farmers Loan and Trust Coinsurance, ruling that a federal income tax was unconstitutional because it was a direct tax that hadn't been apportioned among the states as the Constitution required. The ruling was controversial then and remains debated by legal scholars today, but its effect was clear. If the government wanted to tax income, it would need to amend the Constitution itself. And that's exactly what happened. After nearly 2 decades of political fighting, the 16th Amendment was ratified in 1913. The 16th Amendment to the Constitution was ratified, granting Congress the power to levy an income tax without apportioning it among the states. The initial rates were modest, 1% on incomes above $3,000, rising to 7% on incomes above $500,000. Only about 2% of the American population earned enough to owe anything. It was, in effect, a tax on the very wealthy, sold to the public on the promise that ordinary workers would never be affected. That lasted about 4 years. When the United States entered World War I, in 1917, the top rate rocketed to 67%. By 1918, it hit 77%. After the war, rates came down but never returned to their pre-war levels. The tax base remained wider than anyone had originally promised. Then came the Great Depression and World War II, and the income tax underwent its most dramatic transformation. The top marginal rate reached 94% in 1944. And far more importantly, the base broadened massively. The income threshold was lowered again and again until tens of millions of ordinary Americans, people who had never paid federal income tax in their lives, suddenly owed money to the government every year. In 1939, roughly 4 million Americans filed tax returns. By 1945, that number had exploded to over 42 million. The income tax had gone from an obligation of the elite to an obligation of everyone. The same pattern that played out in Britain played out in America just a century later. A tax born from war, sold as temporary, expanded during crisis, and made permanent by inertia. Every major expansion of income taxation in both countries was triggered by military conflict. Peace never unwound what war had built. One detail completes the pattern. The original 1913 income tax was sold to the American public with an explicit promise: this will only affect the rich. The threshold of $3,000 in 1913 would be roughly $95,000 today. The vast majority of working Americans were told they would never pay a cent. Politicians used this argument repeatedly to overcome resistance. This tax isn't for you, they said to farmers, factory workers, shopkeepers. This tax is for the Rockefellers and the Carnegies. Within 30 years, it was for everyone. The trick that made you stop caring. During World War II, the U.S. government faced an unprecedented problem. Tens of millions of Americans now owed income tax for the first time, but the existing system required them to save up and pay their annual tax bill in a lump sum. Most people didn't save. Compliance was low. The government was collecting far less than it was owed. Enter Beardsley Rumel. He was the chairman of the Federal Reserve Bank of New York, and in 1942 he proposed an idea that would fundamentally alter the relationship between citizens and their government. Instead of asking people to pay their taxes at the end of the year, the government would collect the tax automatically from every paycheck before the worker ever saw the money. Employers would withhold a portion of each employee's wages and send it directly to the Treasury. Congress adopted the idea with the current Tax Payment Act of 1943. The marketing was clever. It was framed as a convenience. No more saving up for a big annual bill. No more worrying about lump sum payments. Your taxes would be taken care of automatically. What it actually accomplished was something far more profound. It made the tax invisible. Before withholding, paying income tax was an active, painful experience. You earned your money. You held it. You watched it accumulate. And then, once a year, you sat down, calculated what you owed, and wrote a check. The loss was concrete. It hurt. It made people angry. And angry taxpayers put pressure on politicians to keep taxes low. After withholding, the experience disappeared. Your paycheck arrived already reduced. The money the government took never passed through your hands, never sat in your account, never felt like yours. The gap between your gross pay and your net pay became a background fact of life, as unremarkable as the weather. This wasn't accidental. The entire point of withholding was to reduce resistance to taxation by making the tax less visible. And it worked spectacularly. Within a few years, compliance rates soared, revenue increased, and the political cost of high tax rates dropped because people no longer felt each dollar leaving their pocket. The government even recruited Disney to sell the idea. In 1942, a short film starring Donald Duck, The New Spirit, was produced specifically to convince Americans that paying income tax was a patriotic duty and that automatic withholding was a convenience, not an imposition. Donald Duck cheerfully filled out his tax forms, while a narrator explained that taxes would keep democracy on the march. 32 million people saw the film. Propaganda and policy working hand in hand. Other countries adopted the same mechanism with similar results. Britain had pioneered source-based collection in the 1800s, and the model spread globally throughout the 20th century. Today, in virtually every country that levies income tax, withholding is the default. The money leaves before you see it. The tax is paid before you earn. The sequence is designed to feel like the natural order of things. Rommel himself later wrote a provocative article in 1946 titled, "Taxes for Revenue Are Obsolete," in which he argued that for a government that controls its own currency, the primary purpose of taxation isn't actually to raise money. It's to regulate the economy, control inflation, and redistribute wealth. The revenue function, he suggested, was secondary. Whether or not you agree with his economic theory, the observation about psychology was undeniable. Withholding had transformed taxation from a visible act of extraction into an invisible feature of the system. The permanent temporary, stand back and look at the full trajectory. For 5,000 years, governments funded themselves without ever touching a worker's wages. They taxed land, goods, trade, windows, fireplaces, salt, doors. Anything they could see, count, or control. The idea that a government could demand to know what you earned, calculate a percentage, and take it automatically was unthinkable. It would have been considered an intolerable invasion of privacy and a dangerous expansion of state power. Then a war came, and in the crisis, a single government, Britain in 1799, crossed the line. It promised to cross back. It didn't. A century later, America crossed the same line. It also promised the tax was temporary. It also never went back. And in 1943, a clever innovation removed the last source of friction. The moment when the citizen actually felt the money leaving. Withholding made the tax automatic, silent, and nearly painless. The government stopped asking for your money. It simply took it before you ever held it. Today, income tax is so universal that questioning it feels absurd. Nearly every country on earth levies some form of income tax. The average worker in a developed economy gives somewhere between 20 and 40% of their income to their government, often more when social contributions are included. The paycheck arrives already reduced. The money vanishes before it materializes. And here's the thing that should give you pause. You've never signed anything agreeing to this. There's no contract, no opt-in, no moment where someone sat you down and explained the terms, and you said yes. You were born into a system that was already running. The percentage was already set. The withholding was already in place. The money was gone before your first paycheck hit your account. By the time you were old enough to understand what was happening, it was already normal, already invisible, already just the way things are. Every year, you file a tax return, a process so complicated that an entire industry exists just to help you do it. You pay for the privilege of calculating how much of your own money you're allowed to keep. If you make a mistake, the consequences can be severe. If the government makes a mistake in your favor, you may never know. The pattern is always the same. A government faces a crisis, war, depression, emergency. It introduces a new tax or expands an existing one, promising that the measure is temporary. The crisis passes. The tax remains. And over time, the temporary becomes permanent. The extraordinary becomes ordinary. And the invasive becomes invisible. The system that began as an emergency wartime measure in 1799, a desperate gamble by a young prime minister fighting Napoleon, has become the single largest claim any institution makes on your labor. Not your landlord, not your employer, not your bank. Your government takes the largest share, and it takes it first before anyone else gets paid, including you. The average worker today spends the first 3 to 5 months of every year working entirely for the government. Not metaphorically, literally. If you add up income tax, Social Security contributions, and other payroll deductions, the math works out. Every hour you work, from January through March or April, depending on where you live, produces income that goes entirely to the state. You don't see it, you don't feel it, and because of withholding, you don't even miss it. But it's there. The largest invisible transfer of wealth in human history, happening in every paycheck, in every country, every 2 weeks on autopilot. For 5,000 years, governments bricked up windows, counted fireplaces, taxed salt, seized grain, and contracted mercenary tax collectors rather than ask a citizen what they earned. The question was too invasive. The line was too sacred. Then one war crossed it, and now nobody even remembers the line was there. Next time you look at your paycheck, look at the gap, the distance between what you earned and what you received. That gap was invented by a man fighting a war he was afraid of losing. It was supposed to be temporary. It was supposed to disappear when the crisis ended. That was 1799. 227 years later, the crisis ended. The gap didn't. It grew. It automated. It became invisible. And it followed you to every country, every job, every paycheck you'll ever receive for the rest of your working life. The next time someone tells you that something is temporary, remember William Pitt. Remember 1799. And remember that the most permanent things in the world are the ones that were never supposed to last. If this changed how you see the number at the bottom of your paycheck, subscribe. We trace the invisible rules that govern your life and reveal who wrote them.